Picture this. It's the end of the financial year for a massive, established company. The finance team, totally exhausted, but they're absolutely thrilled. I mean, their internal books look completely perfect. The execs are celebrating a highly profitable quarter, and they firmly believe they're completely debt-free. They are literally just moments away from reporting stellar earnings to the public and closing the books for good. And then, boom, a key vendor's auditors step in and drop a massive bombshell. They casually claim, hey, actually, you owe us 2 crores. No way, right? But overnight, that false sense of security just vanishes. The market panics, and the company's stock completely crashes. So why did this happen? Well, it wasn't some grand fraud. It happened simply because they skipped one, honestly kind of boring, unglamorous step: vendor reconciliation. Okay, let's dive into this. In plain, simple terms, vendor reconciliation is just the process of comparing your company's accounting ledger line by line against your vendor's accounting ledger. You're basically verifying that both sides agree exactly on what's been billed, what's been paid, and this is the absolutely crucial part: what is still owed. You know, when you have thousands of transactions flying through complex ERP systems, things get lost. This process is your ultimate financial reality check before you close those books. To make this crystal clear, think about splitting expenses on a long road trip with a friend. In your notebook, you jot down that you paid for dinner, so obviously they owe you. But in their notebook, they wrote down that they paid for the hotel, so you owe them. If you guys don't sit down together at the end of the trip and actually match up those 2 lists, you're definitely going to have a fight over the final math. Corporate ledgers work the exact same way, just, with millions of dollars on the line instead of a $50 dinner bill. Let's look at a real workplace example to see how this literally saves the day. Take XYZ Limited. Ria, a finance clerk there, looks at her internal system. It clearly shows she paid vendor A 10 lakh rupees in full. Boom, balance of 0. But wait, vendor A sends over their statement of accounts and they're claiming a pending balance of 1 lakh rupees. Now, because Ria actually takes the time to reconcile the accounts instead of just blindly trusting her system, she spots the gap. The vendor sneakily tacked on a late fee that XYZ Limited never legally accepted. By catching this, Ria officially rejects the charge right before the year-end close, protecting her company's cash and stopping a totally fake liability from hitting their financials. Now, what is really interesting about this breakdown is how it clearly busts the most common beginner confusion out there: mixing up internal matching with external matching. Look at the difference here. A 3-way match? That is strictly an internal check. It's just asking, does my purchase order match my goods receipt and my incoming invoice? Vendor reconciliation, on the other hand, is an external check. It zooms way out and asks, does my company's entire ledger balance perfectly match the vendor's entire ledger balance? One looks inward at single transactions, the other looks outward at the whole relationship. Which brings us to the absolute ultimate auditor's red flag. We insiders call it the blind signature. See, at year-end, vendors send out these balance confirmation letters, asking the buyer to formally confirm their debt. And auditors, they actively hunt for this exact scenario. You've got a mountain of paperwork and a fatigued finance clerk who just blindly signs and stamps these letters without actually doing the line-by-line math. They just want the paper off their desk, right? So they stamp it and move on.
But let's talk about the catastrophic stakes of that year-end laziness. Imagine if you blindly sign a letter from a vendor saying you owe them 50 lakhs, when your internal system says you only owe 10 lakhs. Guess what? You just legally accepted 40 lakhs of fake debt. Literally 40 lakhs. A simple lazy signature suddenly becomes a massive, legally binding disaster for your whole company.
So if you want to avoid massive financial surprises and, actually keep your auditors happy, the absolutely crucial takeaway from this explainer is this golden rule to live by: never sign a balance confirmation without doing the line-by-line math first. Seriously, treat every single vendor statement as a claim that needs to be proven, not a fact to just blindly accept. So we've seen how external vendors can sneak in charges and wreak havoc. But that leaves us with an even bigger, kind of scary question. What happens when the financial threat isn't an external vendor at all, but an invisible invoice generated entirely from inside your own accounting department?